if you are expecting a global recession, you want a good portion of your portfolio to be on cash or cash equivalent. Invest in the market.
Even in times of recession?
Yeah, but here is the deal. There is what we call a waterfall decline. Every recession always has that waterfall decline, that where the VIX spikes above 40. But if you don't have some dry powder, you cannot take advantage of such massive dislocations. As an investor, sometimes you can see a 30% decline, but you know that, listen, this can actually correct. Do you know that the stock market in 2025, at the April lows, the stock market declined by almost 30%. But from that April low to the highs was on the NASDAQ specifically was 39%. So the market recovered
and spiked
and did another almost more than 20%. So imagine if you had sold at the low. That's how a lot of people do what? Panic. That's how a lot of people sell the bottom and buy the top. The best time to buy is when the blood is in the street, including your own blood. So what that means is that as an investor, you want to position yourself to take advantage of declines.
Right from 2025, before the US-Iran war. Now, many Wall Street veteran has projected that there will be a global recession in 2026. And this 2026 match precisely. Will those projections actually come to play? We actually had some conversation that revolve around the markets, the global market, to crash this year. And we are here. Today we'll be looking at those indices that indicates the fall of the market, the crash of the market, those indicators that indicate the fall of the market. Welcome to Clockwise. My name is Providence, and as usual, I'll be doing this conversation with the Clockwise analyst and also a market researcher. Please welcome Mr. Kandem.
Thank you very much for having me once again. Thank you to the audience.
Now this projection started last year, and even before this war, some actually projected that during the midterm election in the United States, there will be a global recession. The global market will actually crash. Now, let's of us stick to what is going on in Iran now. How has this affected the different sphere, the different business area of the war?
Okay, thank you very much once again for having me. So here is the deal. So we had 2023 against analyst expectation. 2023 came out to be a strong bull market.
Okay.
The S&P 500 returned 24%. In 2024, surprisingly, it also was another bull market. S&P 500 returned 23%. And then last year, the S&P 500 returned 19%. Those are 3 strong years.
Okay.
Sometimes when you have those consecutive strong performance, it's sometimes expected that the market will breathe a little bit. So that's why some people were thinking, okay, 2026 might be a down year. In fact, Tom Lee, one of the analysts I respect a lot.
So Wall Street analyst?
Yes, he's the head of research at Fundstrat Global Advisors. He said that this year will have a very rocky.
But he projected
market.
March.
Yes,
he said March 2026.
Yes, he said we'll have a very rocky start to the year, but it will close out very strong. So that also brings the question: are we going to have a global recession in 2026? So by projection, even before the conflict in the Middle East, people actually thought that we're going to have a global recession. So what has happened in Iran, but most specifically the Strait of Hormuz, is actually what has kind of exacerbated the situation. So for instance, you have that since this started, apparently maybe we did not know that this kind of situation would happen in the Strait of Hormuz. Now, you would have thought that, okay, Iran needs to lay mines on the seabed. They need to do a lot of attacks. But the reality is, and of course, you know, the guys on the other end, Israel and the United States, with so much firepower. But what has happened is that the Strait of Hormuz, Iran merely threatened to or destroy any ship that attempts to pass through the Strait of Hormuz. And that was enough to get shipping companies to say, no,
Yes.
we're not going to take that risk. Essentially closing the Strait of Hormuz. Now, I need you to understand, and here is how you are going to understand how the Strait of Hormuz connects with the global recession that we are moseying over. Now, you should understand that the Strait of Hormuz actually is responsible for 20% of global oil movement, oil transport. You have Kuwait, you have Qatar, you have UAE, you have Saudi Arabia. These are big oil,
the Middle East.
Oil producing countries. And all of them rely on the Strait of Hormuz to move their products to the market, to the global market. Yes. So when you have this particular incident in the Strait of Hormuz, that has essentially shut out as much as 20 million barrels of crude every single day. Now, not just that Strait of Hormuz also is responsible for the transport of over about 1/5 also of global liquefied natural gas supply. So what that means is that you're talking about petroleum liquid, you're talking about, in terms of barrels of crude, you're talking about liquefied natural gas. These are the core components of the global energy system. So when that happens, when you have the Strait of Hormuz shut down for such a long time, one of the things you would have, you have not seen the effect as it is now. Let me tell you why. It takes about 2 weeks for the ships to move from there to other parts of the world. So the global community, if I'm to use that, are still relying on what had come in before the closure. And we are in the 3rd week of this shutdown, meaning that's why the projection is that if by the end of March this is not resolved, you're going to have a very significant impact, because a lot of ships are actually on either side of the strait. Some are in the Persian Gulf, some are in the Gulf of Oman. Nobody can move. So you cannot have ships go in to get product. Those that already have products cannot
move out.
Move out. So that's where the challenge is. When you have 20% of the global energy supply out of the system, the next thing you have is that oil prices will go high. Of course, you've already seen that oil prices went as high as $125 per barrel for the Brent. Even the West Texas Intermediate went as far as 119 dollars per barrel. That's an insane jump. In fact, I think Monday of last week, the price of oil did what it has never done before. 35% jump in a single trading day.
Okay, but if all this is actually going on and the US are telling us that they have the capacity to contain the effects of these, are you sure we are actually waiting?
That's why I'm telling you. I'm very certain that the current administration, Trump administration, never expected this to happen. Here is the deal. Yes, you might say Iran is actually not firing any, as it could be. There are no mines. Some of the mines had been taken out. Some of even the mine-laying vessels had been taken out. I believe the Trump administration never believed that by mere threat, the Strait of Hormuz could be essentially shut down. Here is the deal. Yes, it might not be an outright attack, but shipping companies are not going to do that. They take on that transaction because the cost, the risk on that movement would be so high that it will not be profitable. Let me give you some numbers. Let me give you an example so you think about this. Let us say the cost of moving product across the Strait of Hormuz is, let's say, $100 million, for instance. Then the margin is about maybe let's say $10 million, for instance. Let's say 10%. That's the margin. Then an insurance company is telling you that, listen, because of the risk associated with moving across this particular strait, we're going to bump our premium by 7%. Do you know what that means? It means that instead of you making a margin of 10%, 10%, you are now making a margin of just 3%. So it is not very feasible. It is not something that these shipping companies are willing to take.
Okay, now let's look at the fundamentals of each of these companies, because as it stands now, I don't think the market is really driven by the fundamentals. I feel anything Trump says drives the direction of the market, from what I'm actually observing. So let's look at the fundamentals of each of these companies. Are we actually having something affecting the fundamentals?
Like you said, not exactly. But here is the deal. Who is the commander-in-chief? It is Donald Trump. Look, there are two off-ramps to this war.
Okay.
Number one is either Trump. When I mean off-ramp, I mean how we can actually get the Strait of Hormuz to be open. Number one, Trump actually gets boots on the ground.
But there are no boots on the ground yet.
There are no boots on the ground yet.
Okay.
So for you to actually effectively open the Strait of Hormuz, you have to...
You need boots on the ground.
Yeah, there are boots on the ground.
Okay.
That's number one. But here is the deal. Boots on the ground means you are going to be expected a lot of Americans to come back in caskets. American soldiers to come back.
And you escalate the war.
Like what? The Americans have not forgotten what happened in 2003 with the Iraq invasion. No, they have not forgotten. So it's not going to be a politically popular opinion.
Okay, currently.
Yeah, for you to really put boots on the ground, especially given the fact that this is a midterm election year.
Okay.
You have to be very careful and try as much as possible to make politically correct calculations. So that's one option that Donald Trump has. The second option that he has would be, which for me, it's something that I look at it and I don't know how to put it really in terms of how politically correct this would be. The second thing they would do would be to block Iran's because Iran is actually still exporting. As a matter of fact, Iran is still doing 2 million barrels a day.
Yeah.
Yes.
Yeah.
They are still exporting.
China is still buying from them.
It's for Donald Trump to shut down Iran's export. But when you shut down Iran's export, guess what happens to the oil price? It jumps.
There's a ripple
again.
effect, yes.
So he is in between a rock and a hard place.
Okay.
So either of both options can't seem to work, because if you do that, you get Iran to a negotiation. Maybe there's a third option. A third option would be to tell Iran, listen, we are going to allow a ceasefire. We're going to make a ceasefire, but you guys need to...
Are they ready for that deal?
That's where I'm going to. We're going to make a ceasefire. You guys in return have to open the Strait of Hormuz. But guess what? Iran would know that the US is looking for an off-ramp. And so they would want to ask for more. In fact, they would want to ask the US to leave the entire Persian Gulf or take your bases out of the Persian Gulf, which is what Donald Trump wouldn't want to do, because he would look as if he has surrendered.
Yeah.
So there are a lot of chess pieces that come into this, which makes it difficult for you to get a clear off-ramp from on this particular conflict. So the reality is there is a very high likelihood that the Strait of Hormuz will remain closed for the foreseeable future. And that will mean that oil prices will increase.
Okay.
When oil prices increase, guess what will happen? And this affects, remember, not just energy prices, but also the cost of fertilizer.
Okay.
Because a ton of fertilizer comes through that particular Strait of Hormuz. So the cost of food would increase remarkably, significantly. The cost of energy would increase significantly. What that will mean is that the consumer price index will jump. When consumer price index jumps, when inflation essentially, headline inflation essentially jumps, you know what the Fed would do? The Fed would immediately do what?
That will also increase the price of stocks.
No. It's actually the opposite. That means that the Fed would increase interest rates.
Yeah, okay, yes.
And when the Fed increases interest rate, what happens? The bonds become more attractive.
Yes.
So investors would sell off their position from a riskier asset like the stocks
and move to the bonds.
Invest in bonds. That is what will actually lead to a cascading decline in the stock market.
Let's assume, I know you're a very dedicated chart watcher. You actually look at the chart so much and you do a lot of analysis. From your own analysis, would there actually be a global meltdown in 2026?
So, like I said, I don't rely entirely on the chart. Yes, the chart is good. If you look at for example, the Mark 7, that was a name that a lot of us sat on and were so, everybody, literally there were some funds that were investing strictly on the Mark 7, large cap tech. So, but we've seen that the Mark 7 has done over about 14.6% off its all-time high. That's and it actually moved below its 50-day simple moving average. So that, speaking about the charts, that means it's most likely going to go lower. But at this time, you are not going to rely entirely on the chart. You look at the chart and you also look at the fundamentals.
Okay.
So while I was driving at something, I said, when energy prices increase, the Fed, inflation expectations rise, the Fed will respond. The central banks like the Fed, like the European Central Bank, you name it, would respond by increasing interest rates. When they increase interest rates, what will happen? It would slow down. A lot of people will do what?
Sell off.
Sell off their position in stocks and invest in the bond market. Then that would mean that industrial production would what? Would reduce. Expansion will reduce. What follows that? Layoffs. Because if energy price is high, remember that energy costs account for a lot of a significant chunk of the cost center that most manufacturing companies have to deal with. So if energy prices increase and companies are trying to stay afloat, the next thing is they put their people on the chopping board. That means layoffs will increase. When layoffs increase, that means purchasing power would decrease accordingly.
Those are indicators of a recession.
That's what I'm saying. That's how it cascades. That's how it works. So people get laid off. One, that reduces demand. Also, energy prices go and food prices go higher. And these are very essential things for people. So less discretionary spending. And that means that a lot of companies, including the tech giants that you're looking at, will have higher inventories, have greater inventories to deal with. And what that means, it means that they will also continue to do what? To trim their staff. As they trim, it's like a domino. So more people are laid off, purchasing power reduces, companies make less money, more people are still laid off again. So it moves that way. By the time you have this at a global scale, remember, it takes a few countries, especially the US and a few other developed countries. Once recession starts there, it has a domino effect. Because if you look at it, most countries, especially including Nigeria, of course, actually rely so much on exporting to those advanced countries. So when demand slows in those countries, you can be very sure that the demand for commodities, raw materials, which is the major export from countries like ours, will reduce. And when that reduces, that means the recession also would encroach into our country. So that's how the map. That's how it maps out into a global recession.
Now, in case this projection actually materialize, how do you think investors can actually cushion the effects on their portfolios?
Okay, of course, we have what we call defensive stocks. We have what we call growth stocks. I talked about that in an earlier episode. So that's why I am sitting on a lot of, cash equivalent at this point. Not because I don't believe in the stock market, but like I said, you also want, especially when you are managing other people's funds, you also want to ensure that you keep a lot of firepower, dry powder on the sidelines, so you could deploy in the event that there's an increased downturn. So you will want to have a sizable amount of cash on the sidelines at this point. Because, yes, we had said earlier, when the missile is in the air, that's the best time to buy. But there are a lot of things that are coming into play. I had thought that what is happening in the Strait of Hormuz will be just a short-term thing. I believe even the
US president thought so.
Everybody thought that it's going to be because we did not know that just a mere threat by Iran would lead shipping companies to decide to stay off, to stay on the sidelines, And so we thought that, given the fact that US had a superiority, that and of course could take out some of those mine-laying ships, vessels. We thought that the shutdown or the closure of the Strait of Hormuz would be short-lived. If that were the case, then I would say it's just like a fry in the pan. It's not such a big deal. But because it has endured for such a long time, what that means is that we might see a prolonged effect on this. And so, like I had explained earlier, there is a chance that we might slide into a global recession. And if a global recession ensues, that's really the time to buy.
Okay, all right. Now, we've seen this market done the same thing over the decades.
Yes.
You see, after every recession, it's either two things. Either an opportunity for people to take advantage or for others to actually, let's say, cry. Now, I would like you to speak to investors. How should they position their portfolio in case there is a recession today? How can they become more profitable once we move out from this particular phase?
Okay. So sometimes, like we had a recession in 2020, COVID recession.
Yeah.
The stock market rallied in a matter of weeks.
Okay.
So here is the deal. If you are if you are expecting a global recession, you want a good portion of your portfolio to be on cash or cash equivalents.
Okay.
Because that allows you to deploy when nobody can time the bottom. I can't time the bottom. I don't believe that anybody can time the bottom. But if we are expecting declines, you would want to, there's something we call, like you say, dollar cost average. You dollar cost average in and you dollar cost average out. So you keep on investing in the market.
Even in times of recession?
Yeah, but here is the deal. There's what we call a waterfall decline. Every recession always has that waterfall decline, that where the VIX spikes above 40. Historically speaking, once the VIX spikes above 40, you are closer to the bottom than away from the bottom.
Okay.
So those are some things that you monitor, really. But if you don't have some dry powder, you cannot take advantage of such massive dislocations. So the idea is that you should, at this point, you should not be so heavy on
investing
on equity at this point. You might want to start trimming your position. If you have not done so, you might try taking some profits and keeping them as dry powder, so that as the market continues to decline, you could start allocating back into the market. And the reality is that because you cannot time the market, there's something we call emergency contingency cash.
Okay.
What I mean by that is, let me give you an example. So when in 2025, in April, when the Trump debacle happened, so in a day, the S&P 500 nearly triggered the circuit breaker. That event happened on the 7th of April 7th.
Okay.
So when you have such sharp dislocation, you can allocate a chunk of what you have as dry powder. And anybody that did that, not because we predicted that that's going to be the bottom, but like I said, when you have, like, if the S&P 500 in a single day does 3 to 4% correction, that's a decline. That's that kind of decline. What you expect in the VIX might spike up to 60, and that happened in 2025.
Are we trying to see a replay of it?
The circumstances are different. Because we might not expect that very sharp decline, as sharp as that, because that one was, investors did not know how to process what was going on. This point, a lot of things have been priced in. So I expect, even if we have a decline, a global recession, it's not going to be like a waterfall decline. It's going to be something that will take some time. You know, you will still have some people that will be doubting, okay, this is just, and then that's why nobody can actually time the bottom. Okay. Because when you are in the bottom, people still think we can still go lower.
You can still go lower.
Already, people are already talking about another 15% for the Mark 7. 15% decline for the Mark 7. So when you have that, you realize that what if it doesn't do that 15%? So if you're waiting for 15%, then that means you are most likely going to, miss the bottom.
Okay. Now, we're told that once it is 5% decline, that is a pullback. When it gets to 10 to 15%, that is a correction. Now, in the state of a recession, do you advise sell-offs?
When it gets, you have not finished it. When it gets to 20% and above, that is a bear market.
That's a bear market, yes. Do you advise sell-off? Once you see the market start going down to 10%, 15%, do you advise sell-off?
At 15%, you are already closer to the bottom than. So it's a wrong position, the wrong place to sell.
At what point should you sell?
15%. Historically speaking, we've seen the S&P 500 lose 30%. So if you are already at 20%, that's 10% downdraft. Now, if you sell off at that point, so I mean, the distance from the bottom is closer, than the distance from the top. So the advice is that at that point, as a matter of fact, I remember back in 2025 when the S&P 500 made that sharp correction, I was not selling anymore. At a point, I was no longer selling. I was just looking for opportunity to buy. So what I was doing was I was converting some of my other assets into to buy. So, but let me speak to people that are maybe especially newbies that might not be very comfortable seeing their portfolio decline. As an investor, sometimes you can see a 30% decline, but you know that, listen, this can actually correct. Let me give you something to think about. Do you know that the stock market in 2025, at the April lows, the stock market declined by almost 30%. But from that April low to the highs was, on the NASDAQ specifically, was 39%. So the market recovered
and spiked
and did another almost more than 20%. So imagine if you had sold at the low. That's how a lot of people do what? Panic. That's how a lot of people sell the bottom and buy the top. You don't want to, like
I like when you say that.
Buffett said something which is very instructive. Be fearful when others are greedy and be greedy when others are fearful. So it means it's a contrarian approach to the market. When you see people, like they say, the best time to buy is when the blood is in the street, including your own blood. So what that means is that as an investor, you want to position yourself to take advantage of declines.
Okay.
At the same time, you also want to have some allocation to defensives. Coca-Cola, Johnson & Johnson, you name it. Those are defensives because, I mean, healthcare, for instance, whether or not there is recession, are you not going to see demand for healthcare still remains constant?
Yeah.
Have you ever seen someone say, "Oh, because we're in a recession, I'm sick, but I can't go to the hospital"? Doesn't happen.
Yeah.
Then you have also consumer staples. That's why they are called defensives. Consumer staple means you have to eat. Whether there's a recession or there's no recession, human beings have to eat. So those are what we call consumer staples. But things like luxury goods, things like discretionaries, if in a recession, I might not want to buy an Apple phone. Do you understand? So
you don't want to travel.
I might not want to travel. So that's why airline, travel agencies, those kind of, it's mostly discretionary items or stocks. I usually witness a nosedive during recession.
So you advise investors?
I'm advising investors to lean towards defensives.
Okay. Like staple food?
lean towards defensive. I've mentioned a couple of names. You can actually check them out, and more of them are out. And then, apart from defensive, they should also have some cash on the sidelines. I've seen a bunch of investors. Steve Wise. Steve Wise is one of the is a manager, Short Hills Capital. Is one guy that I really follow a lot. So he's actually sitting on 50-50 at this point, literally sitting on 50% in cash equivalent and 50% invested in the market. So because he is expecting that the chances of a resolution of this case in the Strait of Hormuz is very, very slim. For reasons I had told you earlier. There are tough decisions to be made, and there is a very high likelihood that those decisions are not going to be, because anyway you go to, especially because this is a midterm election year, if you go the route of putting boots on the ground and you have a lot of people come back in body bags, that will hurt your party's success in the election. If you say, okay, you want to reach a deal or a ceasefire deal with Iran, that will actually look as if you have actually surrendered. And you can imagine Iran will definitely ask for more, because at that point they know that you're running for the hills. So they will ask you, listen, you guys leave completely. And that is not what both ways are politically suicidal for the current.
So there's no end to this.
So we are still looking. I mean, we just want to watch and see what happens. But if the Strait of Hormuz stays closed till the end of this month, like I said, we have not seen the effect yet, because we are still relying on what had moved before the closure. But if it happens that March ends and that the conflict, the issue around the closure of the Strait of Hormuz is not resolved, then there is a very high chance that you might have a global recession, because energy prices will increase, because the Fed central banks will increase interest rates, economic slowdown will happen, and of course, there's going to be massive layoffs. These are the things that would actually cause global recession. And if it happens in the West, African countries and other countries, developing countries that are exporting commodities. Because if for instance, if a manufacturing company in the US, for instance, has a lot of inventory, they are not going to buy raw materials to produce more. They would want to sell exhaust, sell off what they have in their inventory before they buy more. And that means, especially for most of the countries like, Nigeria and the rest, that really don't have so much around manufacturing, everything they do is basically exporting of commodities. The economy over here would also feel the pain and might also be.
So is your final word? Is your final word? Be careful. What is your final word? My
final word will be, I just hope that somehow we're able to resolve the case at the Strait of Hormuz, because it is an evil wind that does no one no good. That's one. Final word also, especially to investors, will be that this is not the time to go overly into equity positions, because from what I've explained, if a global recession comes around or shows up, then you would have missed an opportunity to make it very, very insane and life-changing buys. Finally, you also have to note that recession is like a Black Friday to the wealthy, the ultra wealthy. I am not scared of a recession. The only reason why
you are very wealthy.
Not exactly, but the point is, the only reason why people feel pain, like you said, some people be crying, if you have not positioned yourself very well, if you have not moved some of your assets to cash or cash equivalents, so you can deploy, you will be seeing insane generational buying opportunities, and you cannot take advantage of them because you are already tied. All of your assets are tied up in equity positions. So you want to, at this point, start making take some profits on the positions you have been in for some time. Ensure that you build up your dry powder so that you can deploy them when the opportunity shows up. If we have a global recession.
That's a very nice place to actually enter this conversation. And I think we should be looking at the stocks to buy during a recession in case we have a recession. Thank you for coming again. Now, on that note, we'll come to the end of today's episode of Clockwise. Please do not forget to like, subscribe, and also put on the notification bell on this channel. And also do not forget that the illiterate of the 21st century are not those who did not go to school or those who will not go to school, but are those who have refused to evolve as their environment is evolving. My name is Providence. I'll see you again.